When it comes to planning for retirement, the choices made within your 401k plan can have a profound impact on your financial future. But here's where things get tricky. Bond fund managers are now under intense scrutiny from those overseeing corporate retirement plans. Why? Because the investment decisions they make or fail to make can leave employees at a significant disadvantage, especially in today's unpredictable economic climate. As we move into 2024, defined contribution plans, like 401ks, are undergoing a period of critical evaluation. Plan sponsors, the companies responsible for managing these retirement programs, are increasingly zeroing in on how bond funds perform amid shifting interest rates. Consultants suggest that this heightened attention is not just a routine check, but a necessary response to an evolving financial landscape. Bond funds, which are typically considered safer investments compared to stocks, are now being called into question due to their performance in a higher rate environment. And this is the part most people miss. Many firms offering these funds haven't adapted their strategies quickly enough to keep pace with rising interest rates. For instance, when interest rates rise, the value of existing bonds tends to drop because newer bonds are issued with higher yields. This creates a challenge for bond fund managers who may have been slow to adjust their portfolios. The result? Funds that were once reliable and stable could now be underperforming, leaving participants with less than optimal returns on their hard-earned savings. But here's where it gets controversial. Should plan sponsors hold bond managers accountable for these missteps? Some argue that accountability is key, as employees trust their employers to vet these options thoroughly. Others believe that education is equally, if not more important, since no investment is entirely risk-free. Adding another layer of complexity, consultants note that some companies are using this moment to revamp their entire lineup of investment options. For example, certain corporate 401k plans are considering replacing underperforming bond funds with alternatives that might better withstand fluctuating rates. These changes highlight the delicate balance between innovation and caution that plan sponsors must strike when making decisions about employee retirement funds. So, what does all of this mean for you, the investor? It means that staying informed has never been more crucial. Are your current 401k investments aligned with both your long-term goals and the realities of today's market conditions? Have you taken the time to review your options recently? And perhaps most importantly, do you feel confident that your employer is doing everything possible to protect your nest egg? This brings us to an intriguing question worth debating. Should companies bear the sole responsibility for ensuring strong investment offerings? Or do employees also share in the duty of staying proactive about their retirement accounts? We'd love to hear your thoughts. Do you agree or disagree with the steps being taken by plan sponsors right now? Share your perspective in the comments below.